are there things that need to be taken care of, not just mental preparation, but financial preparation? What are some of the basics? Like, I immediately think of like cash reserves, Roth IRAs. Where does real estate fall when you're lining up your and look, I'm going to go ahead and take out one of your easy pass. House hacking, I think, is essentially you're buying your primary residence, but you're finding somebody to help you pay that mortgage. So take that off the table. But when does somebody who wants to buy their first standalone real estate investment, are there some financial steps that need to happen first so they don't find out that they might have gotten in this a little too soon?
Like, are you asking, can real estate be the first
I guess because look, here's
someone?
my argument, and I'm trying not to hog the show, but I see, because Scott, I can tell we've gotten a hold of a good one here, so I want to make sure that I give him a chance to actually share. But there are so many people out there telling people real estate is all passive, jump into it as fast as you can, and I just want everybody to have the best, most successful experience with real estate, but it does require, just like Scott talked about, mental preparation and education. There's also some financial preparation that's required. And I wanted to give Scott a chance to kind of lay out the way they look at bigger pockets.
Yeah. So I look, what I think is great about Bigger Pockets is there's a ton of different voices and a ton of different perspectives, right? Bigger Pockets is not my voice. Like I don't have like the opinion. I have one opinion in the crowd. So there will be people who disagree with this. I am a very strong believer personally that real estate investing comes after a very strong personal financial foundation. What does that look like? To me, I'm pretty strict and aggressive. It looks like several $1,000s at least in spread between the amount of income that you make and the amount you spend after tax hitting your bank account, right? You actually have cash to fund major repairs or float the mortgage if you don't have a tenant for a few months, for example. I think that's critically important. Again, people will disagree with me. I think that having the cash to put down on a down payment is critically important. A big pet peeve of mine is when people take out a HELOC on their primary to buy a rental property. You take out a HELOC you take out a HELOC. Not only are you getting the mortgage payment, you're probably getting a few $100 in cash flow, but you got to pay the HELOC back. HELOC is short-term debt. Even if you're being generous and say you're going to pay it back over 5 years, a $60,000 HELOC is $1,000 a month before I get to the interest. So this property is going to suck cash out of your life for the next 5 years, and maybe you'll come out smiling on the other side. But I want each investment personally to bring cash flow into my life gradually and consistently with a snowball building up, not a snowball piling up against me until I get to this other side that may never come for a lot of investors. So that's one thing. So build up the cash and the cash flow. I think it can be as simple as that conceptually. We can get into more details around what is the cash. It's the down payment. It's the reserves you're going to have following the purchase of the property. It's the closing costs and the expected repairs. That's how much cash you should have when going into a real estate purchase. How do you do that? Save your pennies, right? Most of the time, this is a grind for several years that people undertake, right? That I'm seeing from a consistent perspective to get that first property. It gets faster as you buy 1, 2, 3, 4. And I've seen a lot of overnight successes doing it this the responsible way in 7 to 10 years. That's a joke. For the amount of time it takes to really build wealth. Real estate's a great vehicle to build several thousand or maybe a couple $100,000 to a couple $1 million net worth with several thousand to maybe several tens of thousands of dollars in passive cash flow. But it's a 7 to 10 year journey, faster than stock investing on average if you're doing it right and using leverage, with more risk and a lot more time commitment, but a very viable approach for some. Is that answering your question?
It does, but I want to kind of, because it just hit me, and this is something, because coming from a public accounting background where I did tax prep, and I did tax prep for people who had a lot of rental property, and I think about the Great Recession. You'll know who I'm talking about. I want to know, Scott, do you like, because I think a brand new real estate investor will be drawn to the low purchase price but high transient population. But these is you can go buy a house really cheap, get into an area, but you're not going to collect a ton of rent because the clientele is it's not a high income area. Do you buy those to build out the fundamental rental real estate, or do you build your assets up and try to buy more into an area that the purchase price is going to be higher, but your tenant is going to be much more stable and probably give you what? I just want to get your take, because I've dealt with both, and I'd love to know what your thought towards rental investing is on what people should target.
I think I'd go back to the framework I used earlier around, hey, lower income folks in the $50,000 to $100,000 range are typically want to DIY their properties a lot more than the folks that are in the higher income range. So I think it's a question of the time value of your money, right? Someone who's just getting started out making $75,000 a year is not going to have the option to buy a lot of rental property in the $500,000 plus range. That's going to attract your A tier tenants, right? But they will be able to buy property in the more affordable range, right? That's not going to appreciate on average the same way. It's going to require a lot more active management. There's going to be more difficulties perhaps in managing it that you're going to have to get through. But there's also the higher potential cash flow and returns. So I think it's a matter of practicality. That's where you're going to get started if you're an investor that's earning less than six figures in household income and want to get started in this business. And that's a great approach. You do it there. Personally, I'm with you though. Over a long period of time, I'd rather transition out of those types of assets and into a portfolio of the A-class property with really, really good tenants. It'll have less of a cash-on-cash return, but it will be a much better experience, and it may have a similar overall return over a long period of time because of the appreciation and rent growth in those properties.
And how about out-of-town rentals? Because I have a friend who's in real estate, and because our area where we currently live is it had tremendous appreciation. So he was starting to look in other states because the purchase price was so much lower. My spidey senses gave me some pause, but I'd love to hear your take. Do you buy a rental property in an area that's not in your geographic zone?
I think you bias heavily towards buying in your geographic zone. And in some cases, it's just totally impractical, right? And so, but if you're going to buy out of state, then you're going to have to really trust the team that you build there, your agent, your property manager, your contractor, those types of folks. So if you are going to do that, I think it's really good to actually get to know the area, fly there, go look at the property, and commit to it. One of the traps I see with a lot of investors is like, let's say you get a $200,000 a year software engineer out of San Francisco, and they want to go buy in Memphis, Tennessee. So they buy a $50,000 single family home, right? They've got all these problems to deal with. I haven't done all that research, but also even if it goes well, you've got now a property that's going to put $250 a month in your pocket, and you earn $200,000.
Not
right?
moving the needle.
It's just totally insignificant relative to your position, and it's going to occupy too much of the pie chart of your time, even if you try to automate all that stuff. So if you're going to do that, you should go big, right? Intend to go big over 5 to 10 years. Right? I'm not saying take a lot of risk. I'm saying your intention should be, how do I get this thing to actually be 10 to 20% of my annual income in a reasonable period of time? Otherwise, it's not worth doing from a holistic financial perspective.